Hello, welcome everyone. My name is Daniel Jones. I am an attorney with Stern and Eisenberg. And today, hello. There we go. Now I see us. Hello, my name is Daniel Jones. I am an attorney with Stern and Eisenberg, and I am here to talk to you today about brewery mergers and acquisitions. We will give everybody just a minute or so to funnel in. Before we begin the presentation today. So I guess a little bit about me and the beer that I like. Everybody always asks, what's your favorite type of beer? I have to say that it is a solid tie between barley wines and barrel-aged bourbon stouts. They just have that rich flavor that I really love. And I love sitting on a bottle for like a year and then waiting to see what it turns out to be after all that time. I love the anticipation of that. So that's a little bit about me. A little bit about our firm. We are based in the Philadelphia suburbs. We're about an hour north of Philly. We always like to say that, we obviously understand the law as it relates to craft beer world and everything that goes along with it, but we also understand the craft beer culture and find that that is a big benefit to our firm and our clients that we represent. So with that said, we can turn our eyes towards brewery mergers and acquisitions. If you have any questions today and you want to reach out, I definitely encourage you to do so. First and foremost, I am here to help out and be a beneficial resource to you. And because if I can benefit you, then you make great beer and that benefits me. So today, first, before we begin, we've got our legal disclaimer. I want to make sure that everybody knows that anything in this presentation is not meant to be legal advice. It is for informational and educational purposes only. Nothing that we do today is going to create a relationship, an attorney-client relationship between you and myself or our firm. And this is absolutely intended to be completely educational and nothing more. So today we will be discussing three topics with very broad strokes. We're going to be discussing these transactions from the brewery's perspective, just mainly to give you a list of important things to consider if you find yourself in one of these transactions. These terms often blend together. Anybody who took a look at the Sam Adams and Dogfish Head merger that they're calling it, really could see that it's kind of more of an acquisition. So before we begin, we're going to define these terms to use for our purposes today. So we'll start with a merger, which is when two or more businesses come together to form a new business venture. For our purposes today, we'll define an acquisition as an entity or an individual that gains a controlling interest in a business. So here we'll be looking at what a brewery owner should watch out for when a new investor purchases at least 51% of the brewery, and the brewer is going to remain a minority owner or shareholder. Finally, we are going to turn to a sale, which is that you sell the brewery, you're done, you walk away from the business. So first up, we have mergers. And mergers are two or more businesses coming together to create a new business. These mergers are going to be memorialized in what's called a merger agreement. This is going to be one of the most important agreements going forward for the new merged business because it outlines everybody's role, it outlines their duties, and it establishes the rules that are going to govern the business going forward. So a merging business can have a number of benefits. These include, oh, shoot, there we go. All right, now we're on the same screen. Mergers, benefits of merging. So merging your business can have a good amount of benefits for everybody involved. This is going to allow smaller breweries to compete with larger competitors. By pooling your resources, you can really increase your brewing capacity, your distribution capacity, and you can bring more talented people together into the same room. Put simply, rather than increasing your brewing capacity by purchasing a new 20-barrel system, if the brewery on the other side of town has a 10-barrel system, you have a 10-barrel system, you guys want to come together, it could benefit both of you, because now you're going to have that increased capacity and you're going to have increased talent. Yourself as a brewer, that brewer over there who's doing some really cool things, you guys come together and you can do cool things and have much more capacity going forward.
Hey, Dan, I just want to jump in really quickly. Your slides aren't changing. If you just want to test, maybe make them full screen mode. That way everybody can see what you're talking about.
Oh, dear.
But great info so far.
All right, so wait, are we not on mergers right now?
I see mergers now, but it's in the whole mode where you can see notes. You might want to hit the full screen mode.
Oh, boy, everybody wants to read along, huh? All right.
I'll let you reshare it really quickly, and I'll add it back in for you. No worries at all.
Yeah.
And everybody who's listening, thank you for tuning in for Dan and all his wisdom today. And I hope you're enjoying the conference so far. We've got a lot of content for you over the next 2.5 days. So hope you have your computer handy, and it's all available to rewatch forever if not. Dan?
All right.
There we go. Beautiful.
All right.
Enjoy.
Thank you so much. All right. So mergers, extra talent, increased capacity, increased distribution. Mergers also will allow you to restructure some existing transactions. For example, this can mean that merging with the brewery that you currently have a contract brewing agreement with, or it could mean that if you have a disadvantageous distribution contract, you may be able to discontinue that contract if you form a new business by merging with another brewery. That'll depend on the termination clause of your agreement in both situations. So you definitely want to take a look at those if this is something that you're looking into. All right, so here are some of the potential pitfalls for mergers, or at least things that you want to consider or be on the lookout for if you're considering merging. The first and foremost is you want to take care of your manufacturer, your liquor license. This is going to depend on your state law and whether you're creating a new business. Who needs the liquor license? Is it going to be the merged business? Are they going to need a new license, or can they take over one of the existing licenses? And whether it's going to be more of an acquisition where you're going to use one license and drop one. Always make sure that you have the license taken care of first, because that's how you make your money, right? It's also probably going to depend on how many tap rooms you have. And how many tap rooms the merged brewery is going to have. That'll decide how many licenses you need, whether you can keep one and get rid of one, or if you need to keep both and somehow give them both to the merged brewery. You're also going to need to determine what other assets and liabilities are going to be kept. So if your brewery leases equipment, the other brewery owns their equipment, are you going to be able to terminate your lease early to use the equipment that they own? Are you going to keep all of the equipment? You also want to look at what other contracts is your brewery in that you may want to consider terminating if the other brewery has a better deal. So distribution contracts, if you're able to get out of those. If your brewery terminates and you have to start a new entity, it may be easier to get maybe a little easier to get out of those distribution contracts than if both breweries are remaining operating. So which are your distribution contracts? Who at the merged brewery is going to have access to the money? This is always a big issue that you want to take care of. First, you want to make sure that who has access to the money, who is making decisions about the money. You want to consider if one or more of the breweries is merging because their business is struggling. What's the benefit to the brewery that isn't struggling? And if the brewery is struggling, how is this merger going to help them? If they're both in trouble, then you've really got to figure out, you're merging to come together because both of your breweries are struggling. You've got to take a hard look at what you've done in the past to consider what you're going to change going forward so that this new merged brewery isn't going to fall into the same pitfalls that the other one fell into. So really, you're starting from scratch all over again. Think back to when you started your brewery and think about all of the lessons that you've learned and the challenges that you faced, and make sure, I would recommend that the merger agreement specifically addresses each of those issues. It could be vague, but I would recommend that you really spell it out rather than keep the terms vague, because I find that this really limits the issues in the future. Specificity in your merger agreement means that the merged brewery is not going to have as much flexibility as if it were vague, but it does mean that you could reduce disputes later on. Often clients will come to me and say, hey, I have this agreement and I need to figure out what to do now, and the agreement doesn't really say or doesn't really provide for that scenario. So then they have to, work through and the legal system and try and figure that out. Whereas if it's already defined in the agreement, you can point to that and you can say, okay, that's what we do. So if you're going to use an online form to save money, I get it. It happens all the time. At least use common sense, tailor it, at least try to tailor it to your needs. Don't just slap something together and say, okay, we're a new merged brewery and forge on ahead. I can guarantee you're probably going to have some issues if you do that. All right. So next up, we have a new investor situation. Sometimes your brewery is going to need a big cash influx if you're struggling, or say somebody wants to say you're doing really well. Somebody wants to come in and enjoy, partner with you and enjoy your success with you. It may be in your best interest at that point to bring in one or more private investors. And if you do this, you may find yourself in a situation where you're willing to give up more than 51% of the company. You're willing to give up control of the company. So if you're going to give away a majority of your business, but you're going to remain involved or at least invested in the brewery, there are going to be some serious changes that you want to consider. So first, you want to consider why you need this investor. What is this person going to bring to the table that you can't get anywhere else? You can't just go to the bank and get a loan for some reason. You need a private investor. Is it cash? Is it the experience that they're going to bring? Do they have better connections in the industry that's going to help move your business forward? Once you really figure out, why you need this person, it's going to be easier to decide what the acquisition structure is going to look like, because these agreements can take several different forms. So for example, you could have a new silent investor who is simply supplying the funds while you continue to perform the day-to-day operations. It also could be the inverse. If, for example, you're at the end of your career and you're looking to transition the brewery ownership to somebody else, you could also have an even split where someone comes in to work alongside you. Maybe you have they're going to do the front of house, you're going to continue to do the back of house. It's entirely up to you how you want to split the business. And everything is negotiable at this point. That was going to be my note at the bottom. There's no note for some reason, but that is the important note here, is that everything is negotiable. Depending on what the acquisition structure looks like, your ability to make decisions in the business may decrease, which can be very jarring. So make sure that you are negotiating for the benefit of yourself moving forward, so that you're not caught off guard. So here's what to watch out for and make sure that you're not caught off guard, and things that you're going to want to negotiate for. First up, again, the most important thing is to make sure that your license remains valid. This is always the first thing, because without this, you can't brew, you can't sell your product, you go out of business. Always make sure that this is protected. Depending on how much of the farm you're willing to give away, and depending on your state's laws, you may be required to notify your ABC or your liquor control board and let them know that there's a new controlling interest. As most states tend to say, who are the major investors, where do they live, what are their address, what's their contact information. They want all of those things on file. So also, if you are in a position where you're transitioning from a minority or a majority to a minority shareholder, you'll want to make sure that the acquisition agreement allows you to exert control over the brewery going forward. Depending on what state you're in, minority shareholders already have certain rights, and the new majority owner will have to take certain actions to protect your rights. They can't, go out and do certain things to harm the business. They still owe you, depending on the state, they still owe you what's called a fiduciary duty. So these rights are going to vary by state law. So you'll definitely want to contact an attorney in your state to determine what's already covered versus what you need to negotiate for. Most states already have this fiduciary duty. And this means that the majority shareholder has to act honestly, in good faith, and just overall fairness to the minority shareholder. That means they can't do things like self-dealing, things like that are going to harm you or potentially the business. These protections are helpful. I think what is more helpful here for you in terms of protection in the future is going to be your ability to initiate a legal action against the majority shareholder. If you think that they have acted in bad faith, or if they've done some self-dealing, or they've defrauded the business or other shareholders in some way. So be sure next you want to look and be sure to eliminate any measures in the acquisition agreement that prevent you from bringing this derivative action. You will Along with that, you want to make sure that you have a right to look at all the financial records immediately. Sometimes there will be investors will try to work a delay in there, say that they have a month to get you financial records, but by the time you get them, they're already old, and the issue may or may not be resolved at that point. So you really want the ability to look at the accounts in real time, even if you don't have the ability to spend the money or make decisions about the money. You just want to be able to see what's going on so that you can check in on the business. Um, Depending on what other concerns you have, you'll also want to consider adding some other provisions into the agreement that'll help protect your interest and keep the investor from running away with the business. For example, you could consider a capital expenditure approval, which would provide that approval is needed for major expenses over a certain dollar amount, say over $100,000. All equity owners need to approve that expenditure. If you have specific management concerns, you can add specific requirements to the acquisition agreement as well. This will bind the new investor in the future and give you some greater protection. So let's say that you have a new investor come in, but you're going to remain in charge of brewing the beer. You will most likely want autonomy for back of the house so that you can determine what materials that you need in order to brew the best beer possible. If you can't have full autonomy, then you'll want to make sure that there's a provision in the acquisition agreement that says that the business can only buy products of a certain quality. Similarly, if the new majority shareholder wants to sell their share of the business to a third party, you may want to consider a tag-along provision, which would require that third party to purchase the entire business and not just the new investor's shares. This could be beneficial because you don't want to be stuck as a minority shareholder, in a business where you don't know or you didn't sell ownership interest to the individual who's now going to own a majority of your business. Finally, you want to, because everybody wants to be paid, right? You want to set some requirements on when disbursements are going to be made. So generally, I have found that you can set it pretty closely to profits of the business. You can say, for example, if the brewery meets a certain profit goal for a quarter, then pro-rata distributions will be made to all equity holders. This way, the new investor doesn't come in and say, okay, well, I'm never going to make a distribution, regardless of how high the profits are. I'm just going to keep them all for myself. Then you're stuck in a bad deal where you don't get paid until the new investor decides to sell the business. So each of these is something to consider. They each have their pros and cons, and you will definitely want to consider them with an attorney, with your accountant, and definitely talk to the new potential investor about them before you enter into an acquisition agreement. Yeah. All right. We have our final transition type for today, and we're talking about the outright sale of your business. So there are two types of sale. You have an asset sale or a stock sale. In an asset sale, the buyer buys all of the things, all of the equipment, the inventory, the trademarks, the goodwill of the business. Every individual thing that the brewery owns, the buyer is electing which ones they want to purchase. So as a quick aside, this is exactly why you want to make sure that you are doing these little things all along. You want to make sure, excuse me, that all of your trademarks are always up to date, because they have real value, not only in the future, or not only in the present, but also in the future. So make sure that you're doing that now, so that if you ever find yourself in this situation, you're able to negotiate for a much higher price when you're selling. One of the pros to asset sale provisions, one of the pros to asset sales is that they provide the parties flexibility. So, essentially you get to say what you're selling, and the buyer says, all right, yes, I want that equipment. I don't want, that trademark. It provides parties flexibility to decide what exactly they both need. Depending on the rules of your state, it can be difficult to sell your liquor license in this context. So this type of sale may not be as advantageous as a stock sale for anybody who's looking to buy a brewery. So you'll want to look into that before you and the buyer decide what type of sale you're really looking at. As for a stock sale, this is where the buyer buys most of the stock or shares of the business. Essentially the buyer is coming in and stepping into your shoes. They are buying everything. They're buying all of the assets and all of the liabilities of your brewery. So there are a few concerns with stock sales. First of all, because the buyer is buying all of your liabilities as well, you want to make sure that your distribution contracts, they are also buying any of your equipment leases, and they're stepping into your supply agreements. So this is yet another reason why you want to make sure that you're doing everything you can now to make sure that these things are really up to snuff, because you want to negotiate for a better deal now because it helps you now. You also want to negotiate for a better deal because it'll help you in the future. If somebody comes in and says, all right, I want to do a stock purchase, and you're on board with that, and then they start reviewing your distribution contracts and they find that you are in a really bad distribution contract that you won't be able to get out of because of the sale, then they may opt to do an asset purchase rather than a stock purchase because they won't want to be in that bad contract. So these are really things that any contract you enter into, you want to make sure that the termination clause is really strong and as much in your favor as possible. I understand that can be difficult, especially depending on your state, but they are important to negotiate now, and they're going to be important in the future. So next, we're going to look at a few important aspects of a sale, regardless of whether you enter into an asset sale or a stock sale. There are a few provisions. We're going to look at three that you'll want to carefully consider and negotiate. The first is purchase price. It's generally the largest part of the deal, and everybody is, you're negotiating for as high a price as you can get, as soon as you can get it, and the buyer is looking to pay you as little as possible over as long as possible. So the purchase price can take several forms, and you want to consider how much the buyer will pay at closing versus how much they're going to pay over time. There are several ways to value a business. This is generally how you determine what the price is going to be. It's going to be based on the value of the business, what it's worth. And so some common ways of evaluating the business, you can look at comparable sales. You say, well, the brewery across town sold for $1 million or $5 million. Mine is worth, we're better than them, so I'm worth $7.5 million. You can also do multiples of EBITDA, which is a daunting term that is really not that complex. Well, I'm not an accountant, it's complex to me, but it is earnings before interest, depreciation, and amortization. It's all kind of right in there in the name, unless you talk to an accountant, and then that's not me. You can also value a business based on what you think how the business is going to do in the future. You say, we're trending upwards. We're going to do better in the future than we are doing now. Pay us more than maybe what we're worth presently. You can also value performance based on its goodwill. This is the value of your brand. So again, come back to little things like trademarks and contracts, making sure that they're great. And you can also do business synergy, which is your business's relationships. Maybe, you have a really great deal with a supplier, and you've got long-term supply contracts going out the door. That if you're regularly saying that I'm selling X amount a month, and it's based on the same sale every month. For example, if you're going to invest in real estate, do you want a residential investment or do you want a commercial investment? You tend to want a commercial investment because that business is more likely to be there from month to month than the residential is. So once you determine how you're going to value the business, you want to know when and how you're going to be paid. And like I said, buyer is looking to pay you over a longer period of time. And so sometimes the parties are generally not in agreement when it comes to valuation or purchase price. And a good way to find a middle ground is to do an earnout provision. This is essentially, you say the value is you say the value is $1 million, buyer says the value is $500,000, and you're essentially coming together and you're saying, okay, we're going to meet in the middle as long as you meet certain benchmarks in the future. So this can be beneficial because it'll bring the two sides together and allow them to meet in the middle, and you can really structure an earnout based on almost anything that you want. It's all negotiable. So one standard example of an earnout is a very simple one, is you can say that in the year after the sale, if the brewery has a gross revenue profit of $700,000 a year, then the seller is going to pay the buyer an extra $70,000. This is a simple example, and they can get very complicated very quickly. It depends on how many provisions you want the brewery to make, or how many provisions you want to put in the agreement for the brewery to meet after the sale is completed. This does have its potential downsides. The buyer doesn't want to do that additional reporting that's going to be needed, because if you have an earnout provision that says gross revenue profit of $700,000 next year, then the brewery owner then needs to show you the books for that operating year and say, okay, here's how we did it, here's the gross revenue, and then you have to look at it and say, okay, cool, pay me my money. So the buyer has additional reporting to do to you, and then you as the seller, you don't get your money as quickly, and you don't just get to walk away. If you say you want to be done with this business, and you want to move on with your life, then you may not be willing to wait around a year, 5 years, until the earnout provision is met. So it can really bring parties together, but it also has its downsides too. The final aspect of the purchase price that you will want to keep in mind are the tax consequences. I am not a tax professional. I am not a tax attorney. So I absolutely cannot even provide informational or educational materials about taxes. All I can say is, you want to keep taxes in mind. Are you going to want to earn the $1 million all in 1 year, or are you going to want to have that sale price parsed out over a few years so that your income is kept below a certain level? You absolutely want to talk to a tax professional, somebody who is more knowledgeable about taxes than I am, which is pretty much anyone. The next important consideration in your sale agreement is going to be a non-compete clause. This is going to be important if you're looking to stay in the craft beer industry. If you are retiring, you're done, you're selling, and you're just going to go live on a farm somewhere, then you don't really have to worry about a non-compete clause. But if you're planning on staying in the industry, you'll want to make sure that there is no non-compete clause in your sales agreement, or you'll want to make sure that it is sufficiently limited so that you have the ability to operate and earn a living after this sale is completed. So it makes sense from both perspectives, because nobody wants to buy a brewery from somebody who's just going to go down the street, open up a new brewery that's going to be in direct competition with the one they just bought. So if a buyer comes in and says, okay, you're going to stay in the business and you're going to stay in the industry, so I want some protection, it's kind of reasonable. It's then on you to say, okay, but we need to have some limitations on this non-compete clause. And the limitations are going to vary. What's reasonable on these limitations is going to vary wildly based on your state and your geographic location. Because generally, you can say that 30 miles is not all that unreasonable unless you own a brewery in Brooklyn, and if you have a 30-mile non-compete restriction that says you can't operate a brewery within 30 miles, then you're over in Jersey, and nobody wants to be in Jersey. Non-compete clauses are not only they are not only restricted by geographic location, they're also restricted by time. So you want to make sure that the non-compete clause is only going to be effective for a certain amount of time. Say 6 months to a year is generally pretty reasonable. But again, that's going to be based on your state. Every state has a different determination on what it labels as a reasonable or unreasonable non-compete clause. And you have to take a look at your own situation. determine what's going to be reasonable and workable for you. Because if a year and 30 miles is unreasonable for you, then you've got to talk to the seller and figure out, how you two are going to come together to create a deal that works for the both of you. Because again, everything is negotiable, and you absolutely need to negotiate for the best deal that you can get. All right, so our final important consideration is data loss. This isn't one that up until a few years ago I really would have said is all one of the top 3 important considerations of a sale agreement. But with all of the data leaks and breaches and the surprising amount of personal information that some breweries have, I think that this is an important consideration at this point, because the last thing you want to do is complete the sale of your brewery, have a huge data breach, and then have to be stuck trying to figure out what happens next when all you really want to do is retire to your farm and live out your days. So if you are selling data as part of your sale agreement, for example, if you have a mug club list and you have everybody's name, maybe phone number, email, and maybe purchase history on that list, you want to make sure, first of all, that you have a secure way to transfer that information. You don't want to do it publicly or in a manner that anybody else could obtain it. Second of all, you want to take a look at the privacy laws in your state to make sure that this is something that you can sell. So first of all, if you're going to sell data, make sure that you're allowed to sell it. If you are allowed to sell it, make sure that you have a secure way of transferring it. Once you do sell it, you will want to make sure that you are indemnified going forward. So make sure that as part of the indemnification clause in your sale agreement, you are indemnified from any breaches, loss of data, a public exposure of data going forward after you hand it off. You don't want to have a huge data breach and have somebody try to loop you back in to a lawsuit after you've already sold the business and walked away. So these are increasingly of concern, and there are, you can easily indemnify yourself again to protect yourself moving forward. Let's see. As a final note, this is a good time to check your current compliance. This means that going back to your state's laws, make sure that if you have a mug club list or you're keeping track of your customers' purchase history in some way, especially if you're keeping their payment information on file or being stored electronically, make sure that your state allows you to do that, first of all. And if you have a mug club, it might be beneficial to have your customers have them sign up online and click a short terms and conditions so that you are protected and you are telling all of your customers that you're going to collect this information. If you're not collecting information, if you're not going to sell your mug club list as part of your sale, then nothing to worry about. Just make sure that everything's locked down, nobody can get in your system, and you're fine. But absolutely take a look at what you now is always the best time to look to make sure that you are in compliance. With that, I am finished. I will look in a second to see if there are any questions. But I also, as a final note, so I think if you take two things away from this presentation, first, know that everything is negotiable when it comes to any transaction type that we talk about today. Everything is negotiable, and you and any other individuals that you're working with are going to know what's best for that situation going forward. You have the reins at that point. You know your situation better than anybody else does. So you negotiate for the terms that are going to help protect you in the future. I don't know how many times somebody calls and asks and says, all right, here's my agreement. What do I do now? And most of the time the answer is, all right, well, it's negotiable. Your agreement is kind of open-ended. So we have to look at your state laws to see if there are any things that have to be done. Other than that, it's relatively negotiable, how we resolve this and how we move forward. So absolutely know that everything is negotiable and that you are in control of negotiating for your best deal. The second major takeaway is that everything you do now, from your trademarks to your business goodwill, your terms and conditions in any online sales, all of that impacts not only how well your business does now, but it impacts how your business is going to be valued and how well it's going to be able to operate in the future. So all of those little things that, they take up time and they are just incredibly cumbersome. It's every time you put out a new beer, you've got to sign a new little letter that I send to you. And you can ask me, I got to sign another one of these, and say, yeah, you got to sign it every time. It helps protect you now. It also helps increase the value of the business in the future. So this is why I always recommend, even though brewers are incredibly busy, you've got to take that extra step to make sure that you're doing all of these things so you can reap the benefits down the road. At that point, if anybody has any questions that they want to ask now, feel free to comment. Otherwise, that is my email address on the screen. It is djones@sterneisenberg.com. Please feel free to reach out if you have any questions, and I will be happy to talk to you. Like I said at the beginning, I'm happy to help because helping you means that there's more good beer for me to drink, and I like drinking good beer. All right, let's see if there are any questions. And seeing none, I'm going to call it. I hope that everybody found this informative, and absolutely feel free to reach out. Thanks all. Cheers. Bye.